Welcome to this month's Economic Update. I'm Sinead Rafferty, Portfolio Specialist at NAB Asset Management, and I'm joined by our Senior Economist, Bob Cuneen. Welcome, Bob.
Thanks, Sinead.
Bob, we saw some sharp falls in markets in December, which actually led many global share markets into the red for 2018. What were the reasons behind this?
Yes, it was a very challenging and difficult month for global share investors. So there were a couple of factors in play. So if we started off in terms of primary importance, I would emphasise President Trump's trade war. And in particular, we had some events. So President Trump mentioned that he was a tariff man and emphasised perhaps the escalation of the trade tension between America and China. And then we also had the arrest of a Chinese executive in Canada, which also caused some concern about the political risk between China and the US as well. Adding to that was the American Central Bank raised interest rates. We also had some acute political risks in Europe. So in France, we've had the Yellow Vest protests. In Italy, we've had concern about the Italian budget stimulus proposals. And we've also got Brexit. So all these factors have combined to cause global share markets to weaken in December.
So a lot of things for investors to think about. We saw in particular that Asian share markets suffered particularly, like the Japanese market was down around 10% over the course of December. Was that primarily driven by those trade wars?
It is. So basically we've got an environment where Asian economies, because they're very much export orientated to America and Europe, they're highly sensitive to this trade threat. They're also sensitive to the European economic slowdown that we're seeing. So from that perspective, they're ultra sensitive, and therefore we've seen sharper falls in Asian share markets accordingly.
But we also saw that the US Federal Reserve raised rates by 25 basis points in December on the back of previous rate rises that we've seen over the course of 2018. But the market seems to expect or temper their expectations of future rate rises. Was that one of the reasons behind the fall that we saw in global government bond yields?
Yes, so the American Central Bank has raised interest rates 4 times in 2018. And in December, they signalled that it's likely that they will only raise interest rates 2 times in 2019. Because what they can see is that the inflation pressures so far have been quite sedate. So from their perspective, they can be gradual and more patient with the American economy. So from that point of view, that was helpful for the bond market.
Okay. Now, one of the things that was quite interesting was that the Australian share market held up very well throughout December. Was that because it hasn't risen so much in 2018, so it didn't have as much to fall?
Yes, that's a great point, because the Australian share market had disappointed earlier in 2018. So it was surprisingly resilient in December when global share markets came under pressure. So when you look at in price terms, the share market only fell about 0.4% for December, compared to the American share market down about 9% and the global share market down 7.5%. So it was quite an impressive performance from the Australian share market, but it largely reflects that we didn't run hard upwards in early 2018 like Wall Street did.
And what about the various sectors in the Australian economy? How did things go?
For December itself, we saw share market weakness in terms of financial shares, information technology, as well as communications. So they fell between 3 and 5%. Against that, we had 2% type gains for the healthcare and utilities sector. So that helped insulate our market, and that's why we only had a modest fall for December itself.
Thanks for your time, Bob.
Thank you, Sinead.
And thank you for joining us.